Hey, everybody. Today I have Feras Moussa on the podcast. Feras, welcome to the show.
Thanks for having me, Jonathan. How's it going?
Good, good. I'm really excited to have you on the show. Ever since we met for the first time in person, even after knowing each other sort of online for years, we met
It
at,
took way too long.
yes, met for the first time at MFIN. And I'm really excited to have you on the show because you have just built an amazing business. And I want to sort of dig into how you did it and, hopefully educate our listeners a bit on what's possible. So just, give me the quick introduction of who you are and, what business you're in or business
You
is.
bet. So, Feras Moussa, one of the founders of Disrupt Equity. My background is software, so I kind of came out of that tech world, worked at Microsoft, and realized the opportunity is using tech to go into an older industry like real estate and just make us a lot more efficient and effective than others. And so today, we have what we've done. We're coming up. We will cross 1 billion of acquisitions by the end of the year. So we're at that 800 million-ish mark, and TBD if we can find another chunk of deals to buy. But we also have the management company in house. We do first and third party management, and we have a handful of other auxiliary businesses in the same space. And so I like to say we do the A to Z in multifamily, and have some. We're 5% in our journey, have some really ambitious goals over the next 5 to 10 years, and looking to continue down that trajectory. So
So what portion of your business is, multifamily ownership versus management versus the other things that you do?
Oh, that's a I don't actually look at it as portions. I look at it as they're independent companies, right? So
Yeah.
100% of what Disrupt Equity does is sourcing deals and raising capital, right? And then and acquiring. That's Disrupt Equity. Disrupt Management is day-to-day operations. And so, as you know, the acquisition side is really ebbs and flows, right? You make your real money on the exits, and so you don't exit a deal every month, right? It's really about when is it the right point in time in that deal life cycle, a market life cycle. And so that'll be these huge injections of money. And, what we realized during COVID, really, we didn't buy anything for 21 months during COVID, right? It was kind of, we had a deal under contract right before COVID, and that kind of fell apart because of COVID. And, you start to realize the management is valuable because it gives you consistent revenue, right? A lot of people, and whenever I first get in the business, there's always the question of how does a syndicator stay in business, right? Outside of just buying a deal just for the sake of buying a deal, right? If I'm really particular on buying the right deal. And so to not be forced, it's really management. There's always that kind of baseline, very consistent, making what it's doing. And more importantly, it supports, the actual acquisition, which is again where the real money is made. And so I'd say maybe I answer the question a little different. How much of my energy goes towards one or the other? And I'd
Yeah,
say
that's it.
right now, I'd say 50% of my time still goes into management, right? My partner and I, he drives now more the equity side. I'm between the two, and slowly less and less time is going. We have really strong people we've hired on, and I spend a lot more than I ever thought I would on certain salaries and payroll, but it's all about the people. So it's starting to get less, but it's the lifeline of the business. And so I'll hop in, roll my sleeves anytime we need to.
So how many employees do you have in each of these businesses? Roughly, I mean, just ballpark figure.
So roughly Disrupt Management, by the end of this month with a few closes, we'll probably have about 170 employees. And then Disrupt Equity, probably about 15, 20, somewhere plus or minus. So some people are overlapped, right? Like we have a CFO that's overlapped across the two, as an example. So
And on the disrupt management side, so what percentage is in-house management versus third-party management for
about 50,
others?
50.
50-50. Okay. And I mean, that's like a really big thing to undertake. I mean, lots of people kind of have this idea, and I know I did when I first got into the business, like, oh yeah, I'm gonna like one day manage them myself. And then usually what happens is somebody with more experience talks you out of that idea. And you just wind up going with third party management. At the same time, I know that in order to really get into certain kinds of investors, right, to really access institutional capital, you usually have to be self-managing, right? They don't want to see you using third party management. So like, at what point did you start doing third party management, and what was the genesis of that?
You hit it right on the head, right? And you know, you see some guys that'll do third party and it works because they're buying the right kinds of assets. You see some guys that completely implode. It's the wrong management company or the wrong kind of assets. And like you said, management is the hardest business I've ever been a part of. And I've had multiple different companies, right? And I had a friend who built, a successful company, and they grew to 7,000 units. And their one mistake was bringing management in house whenever they were too big, right? Like you could see it, you can almost see the tear that he shed whenever he tells the story because it just completely just overwhelmed them, consumed them, and it just imploded, right? And it really did cause them to implode. And so from him, like you said, I knew that at some point we'd have to bring management in house, right? It's one of those boxes you want to check. It's a way to differentiate yourself, and it gives you a lot more finesse, right, and control of your assets. And then from this friend, I knew that I can't. It's harder to do it later than sooner. And so then there's the other side of it, which is it's also hard to bring management house whenever you're too small, because to really manage, you need to have a substantial amount of people, right? Not even just the on-site; those are a wash, whether it's first or third party, but the back end piece. And so for the longest time, it was kind of the catch 22. And so we did it whenever we were about 2,500 units, right? That was, and we've grown. And in hindsight, it's like, actually, we needed even more back office to do things well than that. So the right number's 4,000, but then 4,000, if you take it over in a day, that's a lot of back office systems and processes to build and do. So yeah, but it's been valuable, right? Again, we're constantly grinding on the management side, for better, for worse, right? Good, bad, and ugly. And then that's why we do third party, right? Doing first party was just not going to be big enough, right? Third party gives us more mass, more ability to have better people, better resources. And so third party has its own challenges, right? You have the occasional client that's just completely will try to run it ragged, and you have to almost coach your team up like, hey, you can say no, like that's not in scope. And so that's why we do third party, just to kind of get enough mass to be able to go have a meaningful impact.
It's funny. I heard a similar story to the one you told about your friend. An early mentor of mine had worked for a company that had gotten to about 2,000 units, at which point they decided to bring management in-house, and the same thing happened to them, like trying to manage themselves. Just basically, they went out of business after working that hard to accumulate all those units. And so that was actually the person who said to me, like, don't do it. Like, you just don't want
Yeah,
to.
and so this friend was 7,000 units. So I
Yeah.
mean, they really had
Yeah.
7,000, try to bring it all. I mean, that's just insane to even think about. So
So so harkening back a little bit to something you just said, where third party management is appropriate for certain kinds of assets. What, now that you have the perspective of as a third party manager as well, what are the right kinds of assets for third party management? Like, where does that really work?
oh, it's funny. So we get brought in at the wrong time. We get brought in to save deals just because we know how to save deals. We are an owner operator. We've saved deals, our own deals, whenever we've started our management company, and we manage for a lot of friends. And so, fortunately, we get brought in to save deals, right? And that works because we know how to do it. But most management companies aren't going to give you that attention, right? Like, we're managing for friends, and so I really, really care about, are we performing, right? Versus other management companies, it's just a fee, right? They don't care, if it's about, hey, can we stay in the deal long enough to make our fee? They're not going to go above and beyond on a certain deal to perform. Whereas for a lot of the clients that we bring, we interview our clients just as much as they interview us. And I look at it as, hey, if we perform on this deal, we'll get the rest of the portfolio, right? And so it's very different. But the simple deals for a management company is your B a, not even A's got its own challenges, but really a B asset, right? Where it's just strong manager that's hopefully in place, or they can bring it in, and you're not doing a deep value add. You're not doing a complete reposition where you're taking it from 90 down to 50 back up to 90, right? A very boring deal is a good deal that a third party management company can typically do. Right. The second you throw capex into it, the second you throw, C class tenant, C class deal, reposition, all of those things, each of those is a factor that will lead to more likelihood of not succeeding.
So, I mean, I don't want to put you on the spot, but this sort of
Huh?
raises an interesting question, which is like, so are you saying that kind of anybody who's doing a value add with third party management in place is kind of taking their chances? Is that fair? And I don't want you to feel like you
I,
have to throw anybody under the bus.
no,
Like, I'm just really curious. I'm really curious about your answer. Like,
I would say the kind of value add, right?
yeah.
If it's, hey, we're upgrading 5 units a month. So whenever the 5 units come available, they get marked offline. That's all the management company is dealing with, and you have a third party doing it. Great, right? If it's, hey, we need to upgrade, 50 units a quarter, right? It depends about the velocity. And we're also going to redo the car parking lot. We're going to redo the exterior, right? I mean, all of this leads to what? It leads to tenants being frustrated. Tenants going to come in saying, I couldn't park my car because y'all towed it, or it's nothing, right? All of this leads to noise for a manager. Then that manager, right, they don't want to handle it. They can go get a job elsewhere. And you see that time and time again. It's that manager is the culmination of success or not success. And so it's about how do you help facilitate and make their job easier. And so I would say it's the amount of CapEx you're doing
Hmm.
and the kind of CapEx you're doing.
So it's sort of like the gradual few units at a time is something that
Yeah,
typical
that's what I was
third-party
saying.
management should be able to
A
handle. Yeah.
boring B property where you're just taking a slug of units, getting them upgraded, you hand them back. You're not asking the manager to go walk the units. You're not asking the manager to go sub it out and deal with that, right? Those are more in line with kind of what a management company can be successful at, right, on the third party side.
And then, a moment ago, you talked about saving deals, and I would love you to kind of illustrate that. Like, so give me a couple of examples of saving a deal. Like, what did the deal look like? What did you have to do to save it?
Yeah, a lot of times it's a couple things. It's deals have severe AP, right? You're talking not 100,000, you're talking 4 or 500,000. They owe a lot of your vendors. That's the first problem. Second of all, poor quality tenant base, high delinquency, right? On 300,000 of collections, you see 150,000 of delinquency, right? I mean, for that current month. So that's really half of what is in there is not even paying well, right? And the last piece is occupancy. So those three things will kill a deal. And so with owners that we bring on, I'm very forward with them saying, look, we can salvage the deal, but we also can't do it without cash, right? We have to be able to burn down the AP to get the right vendors paid. And, we also have our vendors and our reputations that we have to maintain as well. And so we're very clear with saying, like, look, we can salvage it, but here's what we need to have. And I really, really push on the team to be very brutally honest with owners as to what it's going to take, right? And set the right expectations. And then they can hold us accountable to that. Versus if we kind of soft pedal it, right, you're going to come in with, a much different expectation than reality, right? And, you'll be disappointed. And so that's kind of really the thing. So then, once we have AP, then we get in there really quickly, go in there, walk all of the basically existing tenants and see, hey, who's actually skipped, who hasn't. And almost always that 80% occupancy that you brought your deal to us thinking you're at 80%, which to most owners, like, okay, it's not great, but it's not terrible, ends up really being 70% after we take over, the first week, because we get out there and that's just the manager. If you think about a management, what happens? A property gets to 80, low 80s. Ownership puts pressure on the management company reacts and tries to maintain that. They might put pressure on the manager. Manager will stop moving out skips, stop doing all these things just to give the effect that it looks okay, not terrible, right? It's not going backwards. But then the whole thing is actually getting even more backwards, right? So you, as an owner, you step in not really knowing the situation that deal is in. And so again, going back to my example, right? 80% really we take over at 70%. And then that means you have all those many extra deals that have to, extra units that have to be turned, have to be fixed, have to, be managed, right? Now you have a management problem where instead of 5 units a month that have to get turned and released, it's 15, 20 units in one given month. And so that adds pressure on the management, on the manager, and really maintenance and everybody. And so kind of have a special team that will get out there to really help augment, so we can let managers focus on what they do, let the assistant focus on collecting and burning down that delinquency, while we get our kind of A team out there just to really help reposition those units, get them leased, and go from there. And so as I've matured in the business, as an owner, you really want to always push rents, but then you really realize that's on a distressed deal, that's the wrong answer. It's really about getting it filled, even if you get a $200 discount with the right tenants, because operationally, all the difficulties start to go away and then they can focus their energy on the right things, right? Versus if you're also fighting a $200 premium, A, that unit's gonna take a lot longer to lease. B, your staff is just gonna be a revolving door because it's just too much stress, right? And so yeah, I said a lot, so I'll pause there.
Yeah, no, but that's a great answer and really interesting. It makes me really curious about how a property gets to that state. Like, what's the pattern that you've seen about how properties, deteriorate to that point?
Yeah, it's a couple things. A, most owners do not understand accrual financials, and it's sad, right? A lot of people, and you see this, these people that get in the business and kind of forget you're operating a multi-million-dollar business first and foremost, and financials matter, right? And really understanding, and you see this, I have even till this day, clients that we've educated, you still have to almost re-educate them, where they say, but look, my net rental collections was 300,000. Why don't I have 300,000 in the bank, right? They don't understand accrual and you know, what what delinquency does to financials and when it does it, or what concessions do, right? That's first and foremost. The second thing is most of them don't know how to read a balance sheet. right? And that's important as well, right? That's where you can go see your true AP. Time and time again, where owners don't understand, because what do most management companies do? They're too scared to ask owners for money, right? And so if a deal is already borderline, they're going to start to accumulate that cash, make sure the note gets paid, because the note not getting paid is the first red flag for an owner, right?
Mm.
And then they'll make sure payroll gets paid, and they'll make sure utilities get paid. Everything else they will avoid paying to accumulate money for the note for the next payment, right? So if you're not monitoring the balance sheet, you're not realizing your AP has gone from 20 to 50 to 100 to 200. And we took over a deal where the owner thought they had 400,000 of AP. It ended up being 600,000 of AP once our team went in there and actually collected all the statements and scrubbed. And so on top of that, right, that's the next problem, which is managers won't put in everything into the system, right? They'll approve, but not everything is getting put in the system. Those statements, those invoices might just be sitting on their desk. I had a asset manager joke once that he said, hey, we're buying clear desks moving forward so we can see if there's invoices in the drawers, right? And so as an owner, right, or sorry, as a manager, you're not putting in the invoices. So an owner that is not financially savvy, is not understanding accrual, not understanding the balance sheet and AP. And even if they are a little bit savvy, they don't even have the right number, right? And so then, because they're not paying AP, right? You have vendors leaving, the property doesn't look as good, the grass isn't cut as often, the units aren't being turned to the right level of quality, right? So then you have tenants getting more disappointed, so they're not renewing, and then the units that they're turning probably look pretty bad, and therefore you're not getting new tenants. So then it starts to slip, right? And just let this whole story play out another 2 months, and you get to the situation where, oh my God, this deal's 80% occupied now, right? Like, what am I going to do? Oh, I'm going to change management companies, right? Or I'm going to put pressure on my existing management company. And then that's where, they'll let it stall out for another 2 months as a management company where, oh, don't worry, it's not going to go backwards anymore. And that's where the manager will stop moving people out of the system. They'll stop doing these things so it looks good on the surface, but behind the scenes, it's pretty bad, right? And so maybe it rides out another 2 months, and then you rip that bandit off, you make that change in management, and then you really realize what you thought was 80 was probably 70. What you thought was 400 AP is probably 600,000. And again, I say this from my own experience, right? And I'll be the first to take the blame. Like, we had that exact situation, and and I always regret where we knew we needed to make we took over a property with third-party management. About a month into it, I was kind of like not getting the warm and fuzzies from them. And so
Mhm.
me and my partner were talking over, like, let's give it another 30 days. We did. And so then at that 30 days, we're like, man, we really need to change management. And the stupid thing we did was like, well, we're approaching the holidays, right? Like, it's hard to make change in management during Thanksgiving and Christmas. So we'll do it after. And man, it's amazing how backwards they can send a property in 45 days.
Mm.
And so I tell people, if you need to rip the bandit off, do it sooner than later. Don't, like,
Yeah.
these things will go backwards fast. So
I was laughing while you were telling those stories because it's like, oh man, it's like my first deal. I remember I had to replace the management company, and the first management company like very quickly drove the occupancy from like, we took it over at like 95, and then they got down into the 80s, and the market occupancy was like, the high 90s. And at some point, after like months and months of this, and it was always like, oh, no, we're working on it, we're working on it. They they finally said, well, we don't have any money to do turns. And I was like, well, why didn't you ask me for money? Like, you could have asked me for the money to do the turns. And they were like, oh, and there was excuses. And then later on, when we finally did replace them, which I waited altogether too long to do, um, the incoming management company, which was far better, found that they had just been putting bills into drawers and never even entering them into the system to make the financials look better. So for the bank, basically, so we wouldn't go into cash management. So that was an important lesson to learn about.
yeah, so three of the five things that I
Yeah,
said were in your story.
yeah,
And then
exactly.
maybe that leads to the one other thing, which is people not, again, going back to understanding financials, like understanding below the line and above the line and what that actually means, right?
Yeah, yeah.
So, it's all of the above. So it's tough. It's not easy.
Yeah, I mean, fortunately, I had some experience in reading financial statements, maybe just enough to get me in trouble as opposed to like really being able to read the story between the lines. But, I thought I knew what I was looking at. But then, if they don't put it into the system, it doesn't get on the
Yeah.
balance sheet, right? So,
And you hit on something that I tell this to my team, which, so our company core values, right? Two of them, one of them is candid, the other one's transparent. And I tell people it's better to be honest and transparent with owners sooner than let it fester and be a bigger problem later, because that owner may have a way to solve it that you don't know, right? Jonathan had the cash sitting in a manager account, it sounds like. They just didn't ask you for the turn. And so they stumbled themselves. They even hurt themselves even further by not having rent ready units. And then they finally fess up to you 3 months later. But had they told you 3 months sooner, you maybe actually could have gotten a lot more leases, right? And your
Yeah.
brother may have a construction company. You may, who knows, right? It's about, let the owners are fairly savvy people, right? They have connections, they're knowledgeable. Let them help you solve the problem, right?
So how is having your own management company helped your, yeah, the disrupt equity side of the business?
Well, it's given me the George Clooney look, right? I've gotten all these gray hairs, and just kind of thing, and it's
You
it's
cannot tell me about gray hair, Ferris. You can't.
that's fair. That's fair. And so, and I like to joke. My partner Ben has no more hair; he's bald, and so that's why I deal with the management side, because he has no more hairs left to lose. And it's given us a level of control where we know at the bottom what's really going on, good, bad, and ugly, right? And so that's really what it boils down to. And even with our own management company, where we do have that level of control, there are still things that we're like, was nobody going to tell us about that sooner, right? And so imagine if we were a third party, right? And so we have a lot more control. We're able to affect change immediately. Whenever we ask questions, it's not this other random owner on the other side that we can ignore. It's like, no, these guys are asking because it matters, right? Um, and it's given us, I think, a certain level of respect with lenders. That's the other thing that we're starting to see, especially in the environment that we're in, right? Like it's funny, we have a deal that, and I'm not going to mention a specific name, but we have a deal that we bought with a certain bridge lender, and we also managed 2 deals for third party with that same bridge lender. And the bridge lender literally told us, said, we're only approving you guys because you guys have done such a good job on the deal that our own deal. And they were pretty much borderline wanting to try to take that deal back from that owner, right? And we've since fixed the deal and it's getting to stabilization now, right? But it's given us respect. So, maybe it's the best word with lenders, right? And that gives us flexibility, and, to the point where they may start to bring us deals. If they foreclose, they might ask us to manage it. And then that leads to us maybe possibly being able to buy the deal, right?
I mean, I was actually going to say that because I don't know if you know Bruce Frazier.
Yeah.
Bruce is a good friend of mine, and Bruce has developed this expertise on turning around like the worst of the worst deals. And so now he's in a very fortunate situation where in the market where he operates, lenders bring him everything, right? Because they're like, we know that you're the guy who can fix this. We want to, we foreclosed on this, or we're about to foreclose on this, or we're going to force the seller to sell. You're the one that we want to buy it, or we're going to give it to you to fix. And so he gets a tremendous amount of off-market deal flow just from that. Also, the brokers as well know that like they're the ones who can fix the problem deal. So when the brokers
Yeah.
are getting an REO deal, the first person they go to is Bruce, right? So it sounds like you may be developing that same kind of
Yeah,
opportunity.
we're not quite there. We're starting to see rumblings, like brokers for sure. For better for worse. Sometimes I'm like, oh, give me your prettier deals. Like, there's only so many deep turnarounds we want to do, also, right? So sometimes it's just not worth the huge amount of overhead. And so, but yeah, I think we're kind of on the path towards that.
So how has your business evolved over the years? I mean, I think that's a big question, but since you started, other than bringing up management in house, obviously, how have you changed in terms of your approach or your investment thesis, or what you target? What did you learn and how did it affect you?
Yeah, so within multifamily, like, we've done the deep value adds. I mean, we've taken the deal from 80% on paper down to 40%, back up to 95, and sold it. We've done, A, B, C, and right now the C class stuff just isn't priced competitively, and it's just not worth the headache and risk. And so the big thing as we've matured is really understanding and explaining to investors what risk adjusted returns means, right? And the risk adjusted piece of it, which is really, really important, right? And so I think that's one big piece of it. And so we're less interested in kind of these deep value adds. And it's not to say we wouldn't, right? It's about, if it's priced appropriately, I would buy any deal. But the focus has been more on that. we focused a lot more on, we've been bringing brokers in-house, right? So people that were former brokers have really good connections with their people. We have two now that are in their markets that know all the brokers, they're best buddies. They grew up with these guys. They worked together for 10 years, bringing them in-house so we can be sure to get first look at a lot of deals. And we operationalize a lot more of what we do, right? We do use a lot of tech. It's not just in our name, it's in our DNA, right? And we're constantly evaluating what else can we streamline, what else can we automate just to be able to run numbers. And so that's kind of, I think, of what we've done on the multifamily side, and then on just the acquisition side as a whole, right? We've built a brand, we've built the following, and investors invest in Disrupt because it's managed by Disrupt, whatever that means, right? Like you may love us, you may hate us, right? And investors come to us with money they want to deploy. We're obviously can do the multifamily A to Z, but we're really looking at, hey, how else can we expand those opportunities, give investors other things, and how do we build the knowledge in house and the expertise to be able to support all that? So that's kind of where we're headed.
I wanted to ask about the disrupt. What does that mean? And where does it
Oh
come from?
man. So Disrupt was one night me staying up, thinking of a name before I thought this company would turn into anything what it has turned into. And it was really about, again, I came from tech. I wanted something tech oriented and something that just had flair to it, right? Like, and just not norm, right? That's kind of thing. It's real estate is boring, right? It's dated. I wanted something to just be memorable and disrupt equity kind of. I don't even remember what I saw, and it's just like, hey, I wonder if that's available, and ended up being available, right? And so I always joke, because we have a parent company. So maybe back to your question about the structure, we've really restructured the company a lot to where we have a company called Disrupt, right? And one day I would love to buy the domain, but I don't think I'll be able to because it's owned by some like tech founders that made some big exits. I think they just have much deeper pockets, and they seem like they use that domain. So if you check out disrupt.com, you'll see what I mean. But we have a company called Disrupt LLC, and that's really what I call, it provides the backbone, right? The thing most companies aren't good at or don't focus on, which is really sales, marketing, accounting, HR, IT, those 5 disciplines, right? How do we have those best in class? And they provide services into any of our business units. Disrupt Equity is one, Disrupt Management is one, and we have a few others as well. So that's been
But
kind of what we've restructured and thinking about. And so I really look at, how do I get the best in class person sit in that seat and be able to get a compounding effect across multiple businesses.
but like, does disrupt mean anything to you other than just being a cool name? Like, does it inform like what you do on a day-to-day
Yes,
basis or
yes,
how
it
your company
absolutely does.
operates? Yeah.
No, it does. I mean, so, I would tell you our core values, right? So company core values, these are literally on our walls. First one is get shit done, right? Take ownership of the whole thing. Candidness, transparency, resilience, teamwork. And the last one's innovator, right? We don't do what we do because everybody else does it, or that's the way we've always done it, right? We do want to disrupt the norm. I mean, and that's really about taking a step back and saying, is there a better way to do this? And the way we've done our company, and I like to make the joke where one of the first things we did early on that nobody else did was mobile friendly emails. And I kid you not, the following month, 2 other operators I knew had knockoffs of our email, right? And you could tell there's a knockoff because it was rasterized. And so that's just a very dumb, simple example, but it's really about, disrupting what's normal, right? Bringing a level of sophistication, a level of, organization, a level of discipline to an industry that didn't have it as much. And so I'm constantly drilling on people on, hey, what can we do that is bigger and harder that most people won't do? Management is a good example, right? Very few people in syndication have started their own management company. It's bigger, it's harder, it's more challenging, right? And there's kind of really taking that, internalizing that, and being comfortable with that, right? We have 2 full-time developers within the organization building custom software, right? Really, again, disrupting what everybody else is doing and standing out. And so I don't like to do the thing that everybody else is doing because that's not that's not a unique value proposition, right? How do you stand out above everybody else? So
I mean, kind of related to this, one thing I'm curious about is, so your background in tech, how does this affect the way that you run your company now? And obviously the software is the obvious part. So I want to talk about that. I want to talk about sort of how your Silicon Valley background,
yeah.
like what you bring from that experience to this industry.
Yeah, it's funny. Software is the least exciting part of that, right? Like, yeah, software, everyone gets that. But it's actually more about running it like a business, right? And, simple things like KPIs and dashboards, right? Like very few guys have that, right? Regardless of you're in real estate or some other industry. But bringing in a certain level of maturity. CRMs, right? Again, that's the thing that now people have them. But I mean, we've had CRM and we were used to be on Slack. Now we're on Teams. We've had those for like 8 years, right? Most guys got onto the past 2, 3 years, and so it's really a lot of the things that are very normal in tech around tying things together, around pulling this data here, around being able to measure success, around being able to track. Like I can tell you the exact number of deals that we've underwritten each week, each month, and I can have all that data available. I can go back and cross-reference it. I can tell you how many brokerages we have in our system and how many of them sent us a deal per average. Like all of that data we have. And so I can go back in and I can do smart things like when is the last time anyone on our team talked to blank broker, right? And we measure that and really, we don't want that average to be less than 30 days, right? And so we can see when that is and who we need to follow up with, right? Really starting to build those kinds of things that you know eh, people don't think about, right? It's all of the auxiliary stuff because you could be the best person at blank, whether it's I have some AC guys replacing my house. I was talking to the guy. You could be the best guy in the world at HVAC, right? But to build a successful HVAC company, you need to know sales, you need to know marketing, you need to know IT, you need to all of these things that are the outside of it. That's not really the core product, right? And so it's being able to, in tech, a lot of those things are normal, right? Like you don't do a tech company without those things. And so applying that to real estate is really what we've done, and that's just allowed us to stand out and just always try to be a few steps ahead of others. So
And I mean, I'm curious too, whether there's any sort of particular like mindset that you learned in Silicon Valley that you feel is new to real estate.
yeah, it's probably the mindset that everything is possible. Like, I have
Yeah.
I have 10 million ideas, and I have to kind of control myself and just slow it down, right? To kind of let the team catch up before, so I already have that idea for the next 4 things we're going to do, but I just haven't told the rest of the team, right? And, everything is possible. And there's been many a times where the team thinks something's not, and I get in there and I show them, here's how we're going to do it. And then they're like, oh, this is actually really cool, right? And so like right now we have devs building a fully customized Salesforce instance that's going to automate so much of some other stuff and super powerful. And once they see the basis, then they can start to actually expand on the details. And so for me, a lot of times I'm not an expert in any one thing, right? But it's about opening people's eyes and giving them some putty, and then they can mold it into the specifics of what that's relevant to their business or their kind of org. So.
And so how many partners do you have?
Oh, that's a loaded question. So Disrupt Equity, I have a kind of main partner, Ben, right? He's kind
Yeah.
of my main partner on that. And then we have other businesses, right, where we have, a kind of a person that is running but online and we're just the jet fuel around it. So there's probably 4 of those situations.
I mean, the reason I'm asking the question is because
And
oh, go ahead.
sorry, no, and I was gonna say, and really a lot of people are partners. It depends on what you mean fully in partners. So
Yeah, I guess
that's
I mean
kind of
sort of
the
like the people who are sort of running the show, like the original owners of the company is kind of what I was getting
so
at.
yeah,
And
one partner. So
yeah, so what I'm curious about is sort of what the complementary skill sets that you guys bring to the business, right? Because I think one of the keys to business is like you got to have the right butts in the right seats, and businesses don't even in a much smaller real estate company, right? You have some essential, if you want to make it really basic, right? Like the function of sourcing deals and the function of talking to investors are like very different, right? Like there's a guy who likes to sit in front of a spreadsheet in a dark room by himself for 12 hours a day. And there's other guy who would put a bullet through his head sooner than do that. But all he wants to do is talk to investors or brokers or whatever all day long. That is not the same person, right? So you got to have, at the very least, you got to have someone filling each of those roles, right? So I'm
yeah.
curious, and then obviously when you get bigger, then there's more and more of those roles that have to be filled with the right person. But when you guys originally came together, like what was complementary about the two of you that has set the stage for all this amazing stuff to happen?
Yeah, it's funny. So we get asked that a lot, and that's to say the skills that we both have is we're willing to grind it out and step into any role that's needed, right? Like there is no, what's the word? I'm blanking out on the term. Like we neither of us don't care, right? Like we don't, you know, we don't. We're not, neither of us are pompous about it, or, so we'll step in and grind it out, good, bad, and ugly, right? I'm definitely obviously more analytical, more technical, but I'm also thinking really fast on different things. And so it's been complementary in the sense that I have a good partner that's been able to keep up, and regardless of what it is, right? It's not like we had a very clear delineation on everything, right? It's early on, it was actually a lot of blurriness. Like you said, he'd get on some investor calls, I'd get on some investor calls. He'd underwrite some deals, I'd underwrite some deals. So it was really, you do everything, right? And but this kind of ties to your previous question, which is what we kind of what things came from tech, right? And the real example is I read the book Traction probably 13, 14 years ago, right? For my software company,
Mm.
not for that, right? Now you're seeing people that have EOA, you're seeing more operators integrate that into other businesses. But, that's an example of something that we do. We have an EOS, we have a full-time implementer, right? Not a full, sorry, he's not full-time to us, but we have a professional implementer is what I meant to say.
Yeah.
It helps us make sure we have the right people in the right seats, help us kind of identify where the weaknesses are. And that's really valuable, right? Some guys think that's juju, and it's like, well, I could do that myself. And I was one of those. I never thought I'd pay a guy that much money to do it, but it's been invaluable, right? And so that's the kind of thing where, again, in tech, that's the norm. Really focusing on the person, really defining the org chart, really doing these details that matter, that aren't really specific to the core of the business, but do help grow.
So we just have a couple minutes left, and like really early on in this conversation, you said, I think you said, I don't want to put words in your mouth, but I think you said something like you've only accomplished like 5% of what you want to do so far. So what's the other 95%? I want to know where, I mean, you've already really created an amazing business. And so if it's just 5%, like where are you going from here?
I think, so the past 6 months, I was hoping it was going to be 4 months, but we're still in it, has been really, really focused on getting the right butts in the right seats and building the right foundation, right? Like we've rocked the boat on a lot of things, and how we got from there to here is different than how we're gonna get from here to there, right? And really trying to get the right foundation, because we have multiple ways to start to scale, but we can't scale unless we can make sure we perform, right? And that goes for all disciplines, right? There's other sources of equity, other ways to manage. On the management company, we really, it's been word of mouth. We haven't even started marketing it, right? We can go on an M&A spree, and we know how to raise money, go buy other management companies, integrate it, and really scale that, right? And similarly, we just have that same philosophy across other opportunities for investors. And so for us, it's like we have something that works, we've figured out, and now it's about let's go rip it apart and put it back together in a way that allows us to then get a compounding effect. And so that's really why, I genuinely do believe 5-10% of what we're at. And so I think where we're going is more like a Berkshire Hathaway, right? Where we have the right, we have the backbone, we have the right effective leaders that we put in, and it's about tossing jet fuel, right? And so that's really been the vision, really been the big thing we've been doing the past 6 months. And I stress this at every one of our leaders. It's funny, we have our quarterly leadership meeting coming up week after next. And yesterday I was talking to our implementer, and I was just saying, the big thing now is, we have an awesome leadership, but now it's about getting that next level up to that level of leadership too, right? How do we start to mentor and coach and make sure we have the right people in the right seats at those levels, and get everybody excited. And so
Well, on that note, we're out of time, but this has been a great interview. I mean, I can't believe how fast the time flew. So I really appreciate you taking some time with us today and giving us a little bit of the inside view of your business. So appreciate your time today, Ferris.
you bet. Thanks for having me, Jonathan. Always a pleasure.